Okay. Now over here, you know what happens in master budget?
Yeah.
What happens?
Standard rate into standard quantity.
So you have the standard rate for standard quantity. What happens in flexible budget?
Standard rate into actual quantity.
Okay. So over here, this example, they have told you that Louis Limited had production and sales for 20,000 units for his 6 months ending 31st December. This is a budget for 20,000 units. Budget is what? Revenue minus all your expenses. That gives you your budgeted profit. Budgeted profit is your expected profit. Are you with me?
Yeah.
Budget can be a standard budget. Budget can be a flexible budget. Flexible budget is always mapped to the actual quantity. Okay?
Yeah.
And budget can also be your actual budget where you have your actual revenue and you have your actual expenses. After December, it was found that the output was 28,000 units. So can you tell me what is the standard quantity? Can you tell me what is the standard quantity?
20,000.
20,000 units.
And what is the actual quantity?
28,000 units.
28,000 units. That means they want you to flex the budget. They want a flexible budget. Now you should know flexible budget is made on the base of which quantity?
Actual quantity.
Actual quantity.
Quantity. So the flexible budget is made on the basis of actual quantity. So this all is the expenses related to how many units? 20,000.
Or 28,000.
The question is for how many units?
28,000.
The question has a budget for how many units?
20,000 units.
1,000. And you want to make the budget based on how many units?
28,000.
28,000. So can you tell me if I am going to write my revenue over here, what will be the number of units that I'm making it for? 28,000. So per unit, what will be the revenue?
500,000 divided by 20.
You have to divide it.
25.
The revenue 25. So I will take revenue 28,000 into 25. So it will come up to how much?
700,000.
So it will come up to 700,000. So likewise, I have to find the per unit direct material, direct labor, variable overheads, variable selling and distribution overheads. Tell me the fixed cost. Will it remain the same or will it change?
Remain the same.
It will remain the same. So can you give me the direct material cost per unit?
Yeah. 50,000 divided by 21 minute.
How much?
2.5.
2.5.
Yeah.
Direct labor? Five.
Yeah.
Variable production overheads?
2.
2. Variable selling and distribution overheads? 0.5.
Yeah, 0.5.
So what you're going to do is, you are going to use your direct material 2.5 into 28,000. Direct labor would be 5 into 28,000. Variable production overheads would be 2 into 28,000. Variable selling and distribution overheads would be 0.5 into 28,000. So this would be your variable expenses. Remember, you are flexing your budget to 28,000 units. So you're flexing it to 28,000. So whatever is your expense, you multiply it by 28,000 and you divide it by 20,000. This will give you per unit and you multiply it with your number of units. Your fixed expense would remain the same. Your revenue minus your total costs will give you your budgeted profit, and this would be your budgeted profit as per the flexed budget. In the flex budget, you should remember that you are flexing everything to your actual quantity, but you are taking the standard rate. Are you with me?
Yeah.
Yeah.
Come on, make the flex budget. Come on, tell me what is a variance?
Variance is
The
the
difference between
between
standard cost and
and
actual
actual cost.
So it can only be the difference between your standard cost and actual cost, or it can also be a difference in your revenue.
Yeah, budgeted and actual.
Revenue.
It can also be a difference in the revenue. So name the 4 different variances that we are studying over here.
So,
Sales, direct material, direct labor, and overheads.
Sales variance, direct material, direct labor, and fixed overheads. Can you name the 2 sales variants that we are studying here?
yeah, volume and rate.
Rate, yeah.
Sales volume variance and sales rate variance. This is the way you speak. Direct material, what are the 2 direct material variances we are studying?
Usage variance and direct material
Name
usage
it.
variance.
Direct material,
Usage variance and direct material rate variance.
okay. Direct labor,
Direct labor efficiency variance,
variant.
direct labor rate variance.
and fixed overheads,
Fixed overheads volume variance, fixed overheads expenditure variance.
fixed overheads volume variance, and fixed overhead expenditure variance. So can you tell me what is the advantage of variance analysis?
It tells you the difference between them.
Difference between what? In variance analysis, what is actually that you're doing?
You're trying to find the difference between your standard cost and the actual cost.
So you are trying to find a difference between your standard cost and actual cost. Why do you want to know this difference?
To see if your estimation was correct or not.
To see if your estimation was correct or no. If your estimation is bad, you expected a smaller amount of expenses and you did a higher amount of expenses, then what happens?
You did a higher amount of expenses.
Then you get less profit.
That's an adverse.
That's an adverse situation and you need intervention. That means you need to review it.
Yeah.
If it is a favorable variance, you need to see if you can change it more or no, or this favorable situation is because of what? Is it because of the expertise of your staff or what? Okay. So we calculate 4 variances over here: sales, material, labor, and fixed overheads. Are you with me?
Yeah.
Okay, fine. Now then you have this worked example number 3. If you see, they have given you the budget for September, 18,000 units. Can you tell me what is this, standard quantity or actual quantity?
What was, sorry?
This 18,000 units is standard quantity or actual quantity?
It's standard quantity.
Yeah,
It is the standard quantity. Okay. And they have given you the selling price, direct material. Okay. Direct material that is going to be used, cost per kg, direct labor, labor rate per hour, and fixed overheads for the month. They want you to prepare a budgeted statement of profit or loss for Anya Limited. Can you tell me which budget they are asking you to prepare?
Where the budgeted? Is it going to be the actual budget?
This is which quantity?
Standard quantity.
They have given you standard quantity. These are which rates?
Standard rates.
So these are the standard rates. So these are standard quantity and these are standard rates. So which
Yes.
budget have they asked you to prepare?
Master budget.
They have asked you to prepare the master budget. Master budget is based on what?
Standard rate and standard quantity.
Standard rate and standard quantity. It is also called the fixed budget. Okay. Can you prepare the master budget, please?
Yes.
Come on, let's go to the master budget. Okay. We are
Hmm.
going to the preparation of master budget. Can you tell me? We have to take standard rate and standard quantity. Standard quantity is 18,000. Standard rate for the selling price is 32. So your revenue is what? 18,000 into 32. This becomes your revenue. Are you with
I
me?
see. Yeah.
Okay. Now direct material. When I talk about direct material, every unit is going to take 1.25 kgs. Are you with me?
Yeah.
So if I have 18,000 units, 18,000 units is going to take 1.25 kgs and my price per kg is going to be $4. Are you with me?
Yeah.
So this will be my direct material cost.
Yeah.
Now direct labor. Every unit is going to take 30 minutes. So I have 18,000 units. It is going to take 30 minutes. So I can take, it is going to take me 0.5, half hour. Alternatively, you can do 30 minutes. For one unit, it is going to take you 30 minutes. So in an hour, for 18,000 units, it will be how many minutes? You can do alternatively like that.
Yeah.
So 18,000 into 30. How many minutes?
T.
Divided by 60. So in an hour, because you have the labor rate per hour. So it will become 9,000 hours. Are you with me?
Yeah.
Okay. You can do the calculation about the hours and minutes yourself. So 30 minutes, I'm taking it 0.5 and rate per hour. So per hour, it is 12. It is 18,000 into 0.5 into 12. So it becomes 108,000. Are you with me?
Yeah.
You don't need to come at contribution because you're making the budgeted statement of profit and loss. This is just another way. They have not asked you about marginal costing method or anything. So revenue minus direct costs minus the overheads. Your fixed overheads are going to remain fixed, whether it is standard quantity or whether it is actual quantity. So revenue minus all your costs will give you your budgeted profit. Budgeted profit, standard quantity, standard rate. Are you with me?
Yeah.
Ashita, are you with me?
Yeah.
This is done.
Yeah.
Okay, I will move ahead. What have they told me? They have given me actual data. In the actual data, the number of units produced and sold is how much?
20,000.
20,000 units. So this is the actual quantity. This is the actual rate. If I multiply actual rate into actual quantity, I will get what? Which budget?
Actual budget.
Which budget?
Actual budget.
Actual budget. But what they want from me?
Flexible budget.
So if they want from me the flexible budget, I will take the standard rate. That means
Into
I
the
will take the rate from here
Hmm.
and I will multiply it with what?
The actual quantity.
I will multiply it with the actual quantity. It is necessary to flex your budget because you compare your standard rate with your actual rate for actual quantity.
Hmm.
So they want you to prepare a flexible budget for 20,000 units. This is your B1. And in your B2, they want you to prepare actual profit statement for September. Please do it. I will wait for you.
Okay.
So when you're doing the flexible budget, your revenue would be 20,000 units into 30. Flexible budget, 20,000 into 32.
Hmm.
Standard rate, actual quantity. Direct material would be 20,000 units into 1.25 into 4.
Yeah.
Direct labor would be 20,000 units into 0.5 into 12.
Hmm.
Fixed overheads would remain the same and you have the flexible budget profit. Correct?
Yeah.
Flexible budget is what? Standard rate into actual quantity. Are you with me?
Yeah.
Now, actual budget. What is actual budget? Ashita, can you tell me?
Yeah. Actual budget is actual rate into actual quantity.
Okay, actual rate into actual quantity. When I'm talking about actual rate, these will be the actual rates and 20,000 will be your actual quantity. So your revenue would be 20,000 into 30.6. Direct material 20,000 into 1.10 into 4.15. Direct labor 20,000 into 36 divided by 60 into 11. And fixed overheads is 370. This is your actual profit. Okay. Just by looking at this question, can you give me the fixed overheads expenditure variance?
Fixed overheads expenditure variance.
Do you remember the formula for this?
Yeah.
Tell me, which word do you need to remember?
MA, which
MA.
is
What is
fixed
MA?
Master budget
fixed
minus
overheads as per master
Fixed
budget and
overheads
minus
as per master budget minus.
fixed
actual.
overhead as per actual budget.
So it would be fixed overheads as per master budget minus fixed overheads as per actual budget. Can you tell me the fixed overheads as per master budget?
Hmm. Fixed. Oh, it's is it 198,000?
Where did you get 198,000? What is fixed overheads?
Oh, you need. Oh, yeah, fixed. Sorry.
Fixed overhead.
Will it be 360,000?
So fixed overheads as per master budget is 360,000. Are you
Yeah.
with me?
Yeah.
Can you tell me the fixed overhead as per actual budget?
370,000.
370,000. That means you expected that you would spend 360,000, but you ended up spending 370,000. So fixed overhead expenditure variance is 10,000.
Yeah.
Favorable or adverse?
Adverse.
Adverse, because you spend.
Oh, yeah, because you spend more, sorry.
Okay, are you with me?
Yeah.
So we have prepared the budgeted statement of profit or loss for three things together. We prepared our budgeted statement of profit or loss, the fixed budget, that is our master budget, standard cost for standard production, or I would say the standard rate for standard production. Are you with me?
Hmm.
This becomes the standard cost, the total. per unit is the standard rate. Are you with me?
Yeah.
We also prepared the flexible budget. Flexible budget is what? Flexible
Flex
budget is what?
Flexible budget is the standard rate into actual quantity.
The standard cost for actual production.
Yeah.
Standard cost for actual production. Are you with me?
Yeah.
We prepared the actual budget. What is actual budget?
Actual rate into actual quantity.
So actual cost for actual production.
Yeah.
That means there is a difference between your standard cost and actual costs.
Yeah.
So you have to do variance analysis. What you have to do?
Variance analysis.
When you are doing variance analysis, can you tell me you will compare which budget with which budget?
Master budget with flexible budget with actual budget.
So when you are doing variance analysis, you are going to compare your standard cost and the actual cost for actual production. This is something that you need to drill in your mind.
Okay.
Okay, you will compare your standard cost with your actual cost, but you need to flex the budget because your production level should be the same. Okay, now if you see over here, you are going to do variance analysis for these two, right?
Yeah.
As per your expectation, you should have made a profit of 80,000. Please
Yeah.
answer and affirm to me so that I know that you understand.
Yeah.
Ashita,
Yeah, I'm writing everything.
you first understand
I'm understanding this one.
and answer me.
Okay.
As per your expectation, you expected to make a profit of 60,000. Yes or no?
Yeah.
But actually, you made a profit of 18,700.
Yeah.
That means there is a variance.
Yes.
Your standards are not matching the actuals.
Hmm.
Even though the quantity is the same, quantity is actual production. So you have to prepare a budget report for your senior management. What you have to prepare?
Budget.
Budget report for senior
A
man.
budget report for the senior management compares your actuals with your estimates.
Okay.
And it
Okay.
gives you your variance, whether it is a favorable variance or whether it is a adverse variance. Are you with me?
Yeah.
Let's check. Actual production remains 20,000.
Hmm.
Yeah?
Yeah.
Now let's talk about the sales variance. What is your actual sales?
612,000.
112.
What is your sales as per flex budget?
640.
640,000. Please remember the quantity of the units sold is the same.
Okay.
This variance is because of the selling price, because of a difference between your standard rate and
Actual
actual.
rate.
Okay. So you expected that your revenue should be 640,
Hmm.
but your revenue is 612.
Yeah.
There is a variance.
Yes.
How much? Whatever 28,000, it is an adverse variance. Are you with me?
Okay.
Yes.
Similarly, you will write your actual figures for material, direct material costs, direct labor costs. I don't need contribution. We will avoid contribution. Fixed overheads. Okay?
Hmm.
Are you with me?
Yeah.
Yeah.
And you will write your flexed budget over here. Flex budget direct material cost, direct labor cost, and fixed overheads. And you will see. Let's do it. You spent
Okay.
91,300, but you expected to spend 100,000.
So that's
That's
favorable.
a favorable variance. You spent 132, but you expected to spend 120.
That's adverse.
Adverse variance. You spent 370, but you expected to spend 360.
Adverse.
Loss.
Adverse. Can you give me the name of this variance?
What variance? It's fixed overhead expenditure variance.
Fixed overhead expenditure variance. And you have you expected to have a profit of 60,000, but you made profit 18,700. 41,300 is adverse. We are going to study only sales, direct material, direct labor, and fixed overheads variances. Are you with me?
Yeah.
What variance analysis you are doing? This is nothing but a budget report for senior management. What is this?
A budget report for senior management.
When they ask you the budget report for senior management, you will have the names of you will have your budget prepared. Then you will have your actuals, just the total, compared with your flexible budget, just the total, and then a column for variance. You should know what you have to answer when the question is asked. So budget
Yeah.
report for senior management, please make it. I'll wait for you. So can you tell me to find out variance? What do you do?
Oh,
What
which
do
type
you
of?
do to find out variance?
You do standard minus actual.
Yeah.
Standard for what? You need
Cost.
to pull it. Standard cost for actual production. You need to
Okay, so
compare what
standard cost for actual production is
is
compared with
compared with.
actual
Actual
cost
cost
for
for
actual production.
That is a flex budget is compared with the actual budget to find out variance. Now
Yeah.
here they've given you a master budget. They've given you an actual budget. Can you see this?
Yeah.
They've given you a master budget and they've given you the actual budget. Yeah?
Yeah.
And you have to prepare a flexible budget, a standard budget, a flexible budget, and an actual budget. What will you prepare?
standard budget,
Standard
flexible
budget.
budget, and actual budget.
Yeah. And you prepare just a flexible budget,
I
an
did not
actual
ask.
budget.
Actual budget नहीं बोला है but.
They've asked for
For
flexible
variance,
budget.
you need actual budget.
Yeah, but there's no space.
Acha, they've asked for flexible budget report, so we
Make a
need
flexible
actual.
budget, an actual budget, and a report to your senior management. Okay.
Okay.
So we are making a flexible budget. In the flexible budget, what do we do?
Actual quantity into standard rate.
Okay, so the selling price will be
15,600 into 22, so it is 343,200.
okay. The direct material would be 15,600 into 1.2 into 4. Direct
So
labor
it is
15,600 into 40 divided by 60 into 12.
12.
Fixed overheads would remain the same for standard or for the flexed. This is your profit as per which budget? Your flexed budget. Yeah?
Yeah.
Now this is your actual budget where you take the actual quantity and the actual rate. And then you find the variance, just thinking If you've done more expense than your actual, if you've expected more expenses and you've spent less, then it's a favorable variance. Adverse variance you will always put in a bracket. So this is your variance. You expected that you will have 343, but your actual revenue is 312. Favorable or adverse?
Adverse.
Direct material, favorable or adverse?
Favorable.
You spent less.
Yeah, so favorable.
Labor, you have spent less.
Favorable.
Favorable. Why have you spent less on labor?
Because
Can you tell me the reason why have you spent less on labor?
one second. Because they've worked a lesser amount of time.
See properly.
It
You are
says 30.
producing 15,600 units. That is irrespective.
Yeah.
But why has your labor cost? Why is your labor cost less? This is very important thing that I'm discussing.
You've produced more in a less amount of time.
Okay, you expected that your labor would use 40 minutes, but they actually used
30.
That means your labor is efficient. That means your labor is efficient.
Yeah.
Even though they are charging you 2 rupees extra per hour, but they are saving more.
Yeah.
That means you have highly skilled labor.
Yeah, so your average cost of production is lesser.
Yeah, this will come as a theory question.
Yeah, this is like eco.
This will definitely come as a theory question, so you need to know this. Your material. You spent more on material, right? Or you spent less on material?
You've spent less on material.
You have spent less on material. And why have you spent less on material?
Because you're taking less time to make.
Because your
You are buying
direct
the material at a cheaper price and better quality.
Yeah.
Because you're using also less and you're paying also less. That means you found a better supplier.
Yeah.
Check properly. You thought that you will get material at 4 per kg, but you got the material at 3 per kg. That means you found a cheaper supplier. And instead of being cheap, he is still giving you, still the quality is good because you're using less material needed. Do you agree?
Yeah.
This is the analysis section. So you know how to prepare the budget, the report for your senior management, where you write your actuals, your flexible budget, and what? Your variance. With me? Can you tell me,
Yeah.
we will calculate variance for which things over here? Four variances we are going to study in this chapter.
For sales variance, direct labor variance, direct material variance, and overheads variance.
Fixed overheads. Sales would be what?
Sales volume variance, sales rate variance.
Okay, what is the formula for sales volume variance?
Standard
Standard
quantity minus actual quantity into
FR.
into standard rate.
What is the formula for sales price variance?
Standard rate minus actual rate into actual quantity.
Into actual quantity.
Now understand, your total sales variance. Please understand properly what am I telling you. Your total sales variance is a summation of your sales volume variance plus sales price variance. So
Huh?
when they ask you what is the total sales variance, when they ask you what is total sales variance, it is addition of these both. Sales
Okay.
volume variance and sales price variance.
Hmm.
When I say sales volume variance, that means SR. Sales price variance, AQ. Sales volume variance, standard quantity minus actual quantity.
Hmm.
Sales price variance, standard rate minus actual rate. Total sales variance is a summation of what?
Sales volume variance plus sales price variance,
Yeah, you
rate
should know
variance.
this. Okay.
Okay.
Now, what will you do is, you know all the formulas. You know all the formulas. This is
Yeah.
one activity where I want you to try and find the sales volume variance, sales price variance, material usage variance, material price variance, and labor efficiency variance. Yes?
Hmm.
Okay. With the help
Hmm.
of formulas, I don't want you to make the full budget. With the
Hmm.
help of formulas, try to find out this. I will wait for you.
It's not there in the PDF.
Sales volume variance. How do you find sales volume variance?
Sales volume variance is standard quantity minus actual quantity into standard rate.
Okay. What did you expect to sell? What did you
10,000.
expect to sell? 10,000 units?
And
How
you
many
sold
units you sold?
10,000.
Adverse or favorable?
Adverse.
How much? Into standard rate. What is the standard rate?
Standard rate is 8.
So sales volume variance is 8,000.
Hmm.
8,000 adverse.
Hmm.
Please try to do it yourself.
Direct materials
Now we are
price
doing
variance.
sales price variance, right?
I'm seeing it.
Wait, yeah. Formula,
Yeah.
standard price,
Standard rate minus actual rate into actual quantity.
actual quantity is how much?
Standard price is 8.
Actual,
This
oh, oh,
has